So in this video we're going to take a look at one of the biggest markets in the world, if not the biggest, the foreign exchange market. Lots of talk around about possible crisis in the Eurozone, quantitative easing in the US and the UK, so lots of focus on currency markets in general. So today's video, what are currency markets all about? What does a typical currency pair, as it's called, look like? And what are the kind of key influences that will affect an exchange rate? So if you're looking to trade currencies, maybe using something like a spread bet, how would you decide whether a currency is likely to rise or fall? Okay, so key features of the foreign exchange markets, also known as Forex, not surprisingly. Lots of jargon around in this market, and that puts people off, but it shouldn't. Okay, so key features. Number one, this is a 24-hour market. Currencies are traded all around the world, and it is, as I say, one of the biggest, if not the biggest markets in the world. The daily volume or turnover, many times that of something like the equity market, for example. So, 24-hour currencies are traded around the world. Big financial centres include New York, Tokyo, and London. It's a very liquid market. There's another piece of jargon. Liquidity is good. What that means is that for most of the so-called major currencies, and that's a group that includes the US dollar, sterling, the euro, you can get in and out very quickly. Other features. It's not a place for widows and orphans. It's fast. What that means is exchange rates can react very quickly to key pieces of data, and we'll look at one or two of those in a moment. So if you get into the foreign exchange market, make sure you think straight away about how you're going to limit the damage if a trade goes wrong. Maybe using something like a stop loss if you're considering spread betting, for example. And finally, unlike, say, trading shares, it's known as a zero-sum game. What I mean by that is if I go out and buy UK food retailers, I could buy Tesco rather than Sainsbury's. But actually both of those could rise together. I'll still make some money. They could both fall together too. In the currency world it's a bit different. If I decide to bet on sterling, I'm betting on sterling against something else, say the US dollar. Now the point is, one of those will rise and one of them will fall. So in that sense it's zero sum. So in other words, with currencies you've always got to decide what you're betting against as well as what you're betting for. I don't need to do that with shares. I just say I'm buying Tesco and hoping Tesco goes up. But in the currency markets you're always trading pairs of currencies. So as one rises, another falls, and so on. Now it is possible for all currencies in the world to rise or fall against, say, a commodity like gold, but that's not the same point. Within the currency world, everything's zero sum. So you're always trading a pair, you're not just picking off one at a time. And that's something to bear in mind when you trade currencies. If you're bullish about sterling, you are presumably bearish about something else, the euro, for example. Okay, so let's take a look at how a typical foreign exchange quote works. It's a little bit fiddly. It's not quite as straightforward as, say, Tesco's shares, but it's not too bad. So first of all, what are these currency pairs I'm talking about? Well, there are half a dozen or so major currencies around the world. Sterling's one of them, the euro, the yen, the Swiss franc, the US dollar, the Australian dollar, and the Canadian dollar. These are all major currencies. And because currency traders like to keep things quick, they're all shortened. So when you're spread betting, for example, you'll often see sterling described as GBP, and you'll see US dollars described as USD. So all currencies have these little three-letter acronyms. Euro, not surprisingly, EUR, and so on. So make sure that you're aware of what the major currency pairs look like shortened, because otherwise you'll look at that and think, well, I've no idea what that means. What this means is I'm thinking about betting on sterling against the US dollar. Then you get a rate. Now, the currency on the left is the one there is one of. So what I mean by that is a typical rate will come with two prices. Just like when you buy your holiday money. You walk into the bank and you say, I'd like some dollars to go on holiday, and they say, fine, we'll sell you dollars at this rate. And then if you try and go back 2 weeks later and sell some of the dollars you haven't used on holiday, you find they apply another rate. And not surprisingly, it works out in their favour, not yours. Currency markets, not surprisingly, use the same principle across the board. So when you're buying and selling currencies, be aware that the rate will be split into two. There'll be a bid rate and there'll be an offer rate. So what this comes down to is you need to think, am I trying to basically buy the currency in question or sell it? Or am I betting on sterling appreciating or depreciating? So let's put a rate in. So for example, maybe we've got a bid rate of 15586 and an offer rate of 15589. Now, on a screen, it won't necessarily say that this is a dollar rate. It may just appear like that. It may even appear like that. But everybody knows that this is a currency quote. Once you know that you're dealing with this pair, you know that these are dollar amounts. And so let's just turn that into, for the sake of this example, something that looks a bit more normal. So it's dollar rates. And what we're saying here is that if you've got £1 and you're looking to turn it into dollars, you've got to decide which rate the person selling you the dollars at is going to give you, and vice versa. And here's the key. Imagine this is the bank and you've just gone in on holiday. This works in the foreign currency markets too. Whose rates are these? They're the bank's. So, in other words, that's the rate at which the bank sells, and this is the rate at which the bank buys. Or put it another way, from your perspective, this is the rate that you buy at, and this is the rate that you sell at. Or put it even more simply, everybody in the markets is trying to rip you off. So if you're trying to dump £1 and turn it into dollars, you'll get as few dollars as whoever this is can give you. And that means that number of dollars. Equally, if you're looking to buy, they'll make it as difficult or as expensive as possible for you and use the opposite rate. So watch out for that. Currencies feature bid-offer spreads, and when you buy or sell a currency, that is turn sterling into dollars or vice versa, you're always going to suffer whatever that spread is. The beautiful thing about liquid currencies, major currencies, is the spread is pretty narrow. And here's another bit of jargon. The spread here is 3 something. So 86 plays 89. That's a very small proportion of $1, 0.0001 if you like, of the dollar. So that would be known, just a bit of jargon, as a 3 pip spread. That's not particularly important, it's just a piece of market jargon, but it just says, well look, the gap between the buy rate and the sell rate, if you like, is 3 pips, and a pip is the smallest movement in a currency recognised by someone trading it. And in reality it can go below that actually, on spread betting sites for example, but here we're saying the smallest movement recognised for trading purposes is 0.0001 of a dollar. And the price you pay for buying and selling immediately is 3 of those. Okay, the less liquid the currency, the wider that spread will tend to be. Right, what influences that rate? It's all very well saying, well, I now know roughly what it means to buy and sell US dollars using sterling, for example, but why would I? If I was looking to trade, what influences the price of a currency or the exchange rate? And the answer is there are many factors. So what are the influences on a currency pair? So for example, that last one, what's going to change that rate from say 155 something to either 190 something or 125? What's going to move that around? What's going to make sterling strengthen, rise, or the dollar weaken, fall, or vice versa? Now, the answer is complicated. You can write an economics degree on this stuff, but there are some key influences. We can break it down. Number one, trade. Or you could even say trade balances. Okay, countries trade with each other, and they build up trade surpluses or deficits. To cut to the chase on this one, if lots of people want to buy American stuff, they need dollars to pay for it. So, demand for a country's goods and services will tend to drive demand for its currency as well. And that tends to suggest that a successful economy will have a strong currency. And that's broadly speaking true. So, that's one influence. Number two, interest rates. And you might say, linked to that, inflation data. Basically, the price of a currency is dictated heavily by what you can earn if you own it. So, if US interest